Hello, and I'd like to welcome everyone to the ARA BAD INC Annual Stockholders Meeting. My name is Dominic Daughtry, and I'm the current acting CEO of ARA BAD INC. Just to go over a few things regarding our company, most of you who are familiar with our company and our operations already know that ARA BAD INC has been operating for 6 years. Currently, we have 2 manufacturing plants, America 1 plant, which supplies America 1, 2, and 3. Those are our domestic sales offices, and we recently opened our Pandow plant, which is self-sustaining and supplies only Pandow. Our current strategy is a differentiation strategy through quality and features. We believe in a premium product at premium prices. Those have always been our long-term goals, and those have not changed over the last 2 years. Currently, we employ a corporate structure. It's a divisional structure, top-down directives flow, and a bottom-up reporting flow. Growth strategy, loyalty to our country of origin, which is America, and limited outsourcing, which may change in the future depending on resources and competition. And we do believe in sustainable growth. Currently, from our 4-year, our 4th year, 2-year plan, the only changes to our organizational chart over the 2 years have been our Pandow plant, which was opened recently, and that has been tasked to Roger Mock for operations. Currently, our goals and objectives from our 4-year plan, we have underperformed in almost every area. We are not very happy about that. We plan to take steps to remedy these problems. Those will be gone over further by Aaron Maradian and his overview. Our weighting factors from our 4-year plan, we feel that many of our weighting factors are on point with our goals and directives, except for our UPC, which we had allocated 2 points, which is actually a 10% allocation. We had wished that we had definitely put that as 0. Moving right along, I'd like to hand it over to Aaron.
My name is Aaron Maradian, and I'm the FSO for ARA BAD Incorporated, and I'm going to be talking about the weighted factors. What we planned originally was to have a continuous growth at a sensible pace. We also planned to be one of the top industry leaders. Unfortunately, it's not how it came out, and our actuals in our industry became more competitive, loss of market share, and resulting in sales decrease. Also, the union production costs grew at a significantly rapid pace. As a result, net income decreased drastically. ROA and ROE unfortunately moved in the same direction, resulting in a drop-off. Finance expenditures with a combination of bonds and bank loans were used to move operations in Pandow. Moving on to the future, though, we're very optimistic that we'll make a strong comeback. Our goals are for retrenchment in order to stabilize our company's assets and equity, lower UPS costs and increase net income, reestablish market share in our customer goals and needs, pay back remaining some of the loans to increase our credit rating. Based on these graphs, our ROA and ROE were very similar. They both had a significant drop-off. Our actual, compared to our forecast and projected, has a big difference. The ROE was 60% and 78% for year 5 and 6 respectively. Our market share also decreased. One of the main causes was the fact that our production costs increased, and to keep our margins, we had to increase our prices. And as Bonnie had said earlier, hit that price ceiling, and we lost a larger portion of our market share. Our stock price, even though originally we came out very strong with industry leaders, in year 5, quarter 3, our stock price began dropping due to decrease in net income as well as high competition from our competitors.
Here at ARA BAD INC, our main corporate strategy was one of planned consistency and growth. What actualized over the last 4 years was that planned consistency and growth, which fell off the last 2. Our future plans are getting back to basics and making sure that we get back on track, and we think we have the right plan to do it. Our competitive strategy, as Dominic touched on earlier, was one of differentiation, and one of the main ways we did that was keeping production local and in America. Over the last 2 years, we did feel the need to bring production out to Pandau, a small plant, in order to make them self-sufficient and help drive down some of our costs. In the future, we see going forward keeping that small plant in Pandau, but also it's important to us to keep our main plant here in America. Unit price, we had planned a slow and steady, consistent growth of 10 cents per unit raise each quarter, keeping America 1 always 15 cents higher than M2 and 3, considering the higher quality and features. It didn't quite work out that way. Once we started losing market share and sales were dropping off, we had realized that we had hit a price ceiling and that our customers were no longer willing to pay that price. You can see the differences. Advertising dollars, again, we had planned slow and steady advertising growth during our down periods, and also when introducing new model. We felt that it was important to let the customers know that we were local here in America. Once we started losing sales, we had to use advertising as sort of a band-aid, and we ended up increasing a lot more than we had originally projected. Training expense, again, as we started losing sales and market share, we needed to cut costs somewhere, and unfortunately, in the short run, training was one of those places. We foresee going forward that we'll continue to keep training steady, only increasing when hiring new employees and also introducing new models.
Hi. So originally we planned to produce a healthy amount of inventory to meet our demand, and we also planned to produce in 10 lines within America. But some of the actualities was that the inventory changes were very inconsistent with our expectations, and also we had 8 lines in America and 2 lines in Pandau. Some of the reasons for these changes was the unit sales were inconsistent with the forecasts. There's a decrease in our market share, especially in M2 and M3, and we had a strong unexpected rise in production costs due to models, qualities and features, and our use of overtime and second shifts. And lastly, we have made a lot of changes to production to meet our demand and stay competitive. So this is our inventory levels. As you can see, we overall we kept up with the trend, but during year 5, quarter 3, and quarter 4, we did have stockouts. We weren't the only exceptions. Virtually all companies stocked out in quarter 4 of year 5. Here we have the production schedule. As you can see, the first 3 quarters we did do exactly as planned, but we started to deviate from the original plans due to our forecasts of much greater sales than what we expected. So we did change from what we originally planned. As you can see, because the first 3 quarters we were very consistent with our plans, we did not deviate more than 10% of our expected estimates. But after starting year 5, quarter 4, we did have high deviations. We deviated as much as 56% from our forecasts. And for unit production cost, as you can see, unit production cost didn't change more than 23%. But again, after year 5, quarter 3, they did change significantly compared to just a 2% change in the first 3 quarters of our estimates.
I'm going to analyze our income statements. First of all, for our gross profit, we had a $5 million decrease from what we expected. That was due to unexpected liquidations of $469,000 occurred, and if we fail to meet our demand, then it affects on our sales. And for our total selling expense, mainly due to our low sales, we raise our advertising costs higher than we planned and lower the salaries and commissions because of deactivating second shift in 2 different areas. So our total selling expense came out $3 million lower than what we expected. For our operating profit, again, mainly due to the decreasing in our sales, our storage expense is almost double than what we planned for, and because of new plant and line in America 1 and Panda, we had such a high cost on executive compensation, and in order to increase our leverage from our lower sales, we have to put about $150,000 in our bonds interest, and it drew us to total operating profit $400,000 more than what we planned for originally. And lastly, not as we had planned, our sales decreased and it drew negative income at the end of year 6. In order to recover the low sales in each quarters of year 6, the company's expense increases significantly. And by the year 6, the company's income decreased by 98% from the year 5.
Hi, my name is Hyung-Gyu Jae. I'm gonna talk about operating section in cash flow statements. The first, in year 6, our company had net operating cash inflow of $323, which was much less than we projected. Due to the decrease in sales, we had much less accounts collected, and also due to the 2.5 million loans from bank, our interest paid was doubled as 450,000. In other words, we received less and spent more, so our net operating cash inflow dropped dramatically than we projected. For the investing section, our company had the strategy that no planned expansion in Panda. However, since we changed our strategy, we spent additional 1.1 million for new lines and 3.3 million for plan in Panda. Because of this, our company had net investing cash outflows of 4.5 million in year 6. Last, for the financing section, our company made 2.5 million loans from bank and sold 2 million of bonds to cover up the expansion in Panda. Therefore, we ended up with net financial cash inflow of 1.7 million. For next, this is the asset in the balance sheet. Since we spent lots of cash for expansion in Panda, we just had 745,000 cash on hand, and it decreases our total current asset from 14 million projection to 5.1 million actual. Also, because of planned expansion, our fixed asset increased to 13 million actual from 8.6 million projections. Since decreasing in current asset is much bigger than increasing in fixed assets, we have 18 million total assets compared to 23 million projected total assets as end of year 6. For the liability, we make an emergency loan of 339,000 and we issued 2 million of bonds. So our total liabilities increased to 6.6 million from our projection of 5.2 million. For equity, we projected that we had 13 million of accumulated earnings in year 6, but due to the decrease in net profit, our company just has 7.4 million of accumulated earnings, and it decreased our total equity to 11 million from 18 million projections.